It made the news multiple years in a row that 9 out of 10 landlords make mistakes on their tax return. And guess what? It's still happening. Some landlords are claiming too much, and some are missing out on the things they could claim. I'm going to show you the most common mistakes and a secret deduction that many landlords have missed out on. Now, here's the big update. The government just gave the ATO $1 billion to catch people who messed up their taxes. And that's in the federal budget 2025-2026. And since 2022, the ATO already spent $290 million just looking into individual tax returns. People who make dodgy rental claims, claiming too much for working from home, or forget to tell the ATO about their side hustles. It means more people will get audit letters. The ATO has better tools now to check your numbers. And it's going to be a lot harder to get away with mistakes on rental property tax claims. So, number one error is repairs versus capital improvements. When you repair something, you've just put it back the way it was. The cost is a straight up tax deduction today. But when you make a capital improvement, you are upgrading. Newer, bigger, better, and longer lasting. Those costs have to be claimed slowly over time. Let's go through a few quick examples to help you understand the difference. So, for example, the roof. If a storm cracks a few tiles and you just replace those damaged ones to make the roof watertight again, that's a repair. You can claim full deduction in the same year. But if you rip off the old tiles and install a brand new ColorBond roof, that's a capital improvement. You cannot claim it all at once. Instead, you will have to depreciate it at 2.5% over 40 years under Division 43. And I'm sure as landlords you are familiar with assets under Division 40 and capital works under Division 43. And the second example is like painting. If you patch up a water stain and repaint one bedroom, that's a repair. Again, you can claim it immediately. But if you repaint a whole exterior of the house in a new trendy color or repaint every wall in the property, that's not a repair, it's a capital works. So you will be claiming that over time. And the third example is an oven. Let's say the oven stopped working because of a faulty thermostat and you replace just the thermostat. So it's a repair. Full deduction straight away. But if you throw out the oven, install a brand new one, that's a depreciating asset under Division 40. You will need to write it off over the effective life of the oven. So here's a quick cheat sheet to wrap everything up. Think of things like replacing a cracked window pane, refitting a loose fence, or regrouting some shower tiles. Those are minor, like for life fixes. They are considered repairs, so you can claim full cost in the year you do them. Now, if you replace the entire part of the property, like putting a new roof, doing a full exterior repaint, or installing brand new kitchen cabinets, that's not a quick fix. That's capital works, and you cannot claim it all at once. And on the other hand, if you buy a new standalone items like aircon, a dishwasher, or a cooktop, those are called depreciating assets. You can claim them under Division 40 based on how long they expected to last. And one final tip, if you do any of this work before the property is available to rent, it is always treated as capital. No instant deduction. Finally, document everything. Separate invoices for patch and paint versus repaint jobs. Take a photo for the before and the after, and that way if the ATO comes knocking, you've got evidence to back yourself up. The second common mistake is private versus investment. Did you withdraw your investment loan to fund a new car or family holiday? The interest on that portion becomes non-deductible because the expense does not generate assessable income. And yes, the ATO gets this data straight from the banks. So keep a live spreadsheet that records every withdrawal, what is for and when. Better split your loans so personal withdrawals are completely separate. Another example is you cannot claim full year deductions if your holiday home is only technically available for rent, especially if it's listed at very high prices just to keep it empty. The ATO looks for proof that you genuinely try to rent it out. So just remember to save screenshots of online ads, pricing that matches market rates, and a booking calendar that shows actual availability. And this last one is just common sense. If you paid to install a new kitchen in your own home and not your rental property, it's obviously not deductible. The third common mistake is traveling costs. Here's the one that people often get wrong. So since 1 July 2017, travel to inspect residential rental properties is not deductible. That flight to inspect your investment in Cairns, nice trip, but not deductible unless you are running a full-scale property letting business in a company structure. Next one is secret deduction, because up to 80% of landlords miss out on perfectly legal deductions just because they assume an older property has nothing left to depreciate. In reality, you can still claim capital works write-off on the building itself as long as you get a quantity surveyor to prepare a depreciation schedule. So why the confusion? Because in 2017, the government stopped landlords from claiming depreciation on any plant and equipment items that were second-hand. That means if you bought a property with pre-loved carpets, hot water units or dishwashers, you can't depreciate those items under Division 40. However, you can still depreciate brand new replacement you install yourself. And Division 40 capital works deduction on the building structure are still fully available. So just order a quantity surveyor report, the fee is deductible, and even on a decades-old property, it could unlock thousands in future tax savings. Now here's the big tax tip most people totally missed, especially if you are building a rental property. Let's say you take out a loan to buy land and build a property for investment. The loan actually needs to be split into two parts. One part goes to buy the land and the other part goes towards the construction. Now here's the secret. The interest on the construction part, that's tax deductible right away, even before the rental is available. If your accountant says it's wrong, ask them to come and talk to me. But the interest on the land part, you cannot claim it until the house is ready to rent out, unless you are running a business in a company. So there you go, big savings are hiding in tiny details. And final reminder, let's be real, getting audited isn't just about paying back the tax shortfall. The ATO can impose penalties of 25% for carelessness and up to 50% for reckless errors. If they find consistent mistakes, they can go back up to 2 years for individual return. If there's fraud, like fake invoices, they can go back as far as they want. And finally, if you find this video is helpful, don't forget to like and subscribe. I'm Hannah, the tax advisor you can trust. Thank you for watching and see you next time.